So what is average true range? Well, let's take a look at it. Average true range, or ATR, it is, as is commonly known, is a technical analysis volatility indicator originated by J. Wells Wilder. J. Wells Wilder was a commodity trader, and one of the things that he had to deal with was the volatility in the commodities market. So one of the indicators that he did develop to deal with that is the average true range. The true range is the largest of the following: the most recent period's high minus the most recent period's low. Absolute value of the most recent period's high minus the previous low, or absolute value of the most current recent period lows minus the previous close. So let's take a look at what exactly that translates to. What that translates to is that what we're trying to measure here is the volatility of the instrument. When we're trying to measure the volatility of the instrument, what we're looking at is whether the range is expanding or contracting as compared to the previous bars. Many times the set default is 14 periods. So what that means is that they're going to average the last 14 periods of average true range. What this indicator does not do is help you time into a trade or determine the price trend. It is meant merely to qualify instruments to see if you should be trading them or not. Let's go to the charts now, and I will show you exactly how I use average true range. On the chart of the GC, or the gold futures contract, what I've shown is just the price action in the form of candles and an average true range indicator. The charting platform that I'm using today is NinjaTrader. So what you have on this average true range indicator is that you have a line going up and down. So basically when it's going up, that means that range is actually expanding. When range expands, that means that the bars, the range of that bar, is more than the bar before it. So if it keeps expanding, that continually happens. If it actually is contracting, or the range of the bar is smaller than the previous bar, that means the range is contracting. So why is that important? Well, I personally day trade, so what I look at is the daily average true range. That to me represents the amount of movement on average that that instrument moves during that period, which in this case is a daily. Let's take, for instance, going to the hard right edge here. Right now, the average true range is 16.27. What that actually means is that the range of the day, on average, moves 16.27 points. Now, the higher the range, like if you get up to about 25 here, that means the day's range is going to be 25. How that affects your trading is that if you go down to the smaller time frames, for instance, let's go down to the hourly. On the hourly time frame, what you have is that you're going to have your bars that help determine the trend. But, it's all going to be within context of the average true range. So, for instance, if you started the day, let's say at 1600, and your average true range going back to the daily chart was about 16, you can probably, depending on which way this goes, look at either a topping out of 1616 or going down to about 16 or 1584. If you're looking at the average true range, if it moves just south of that, it's going to go down to 1584. If it just goes north of that, it's going to move down up to 1616. And what that actually means for traders, especially intraday, that where you have to time in, is that if you time into an instrument that has a very small average true range, you are many times going to be chopped up or or shaken out of a trade. And the reason it is because the instrument is not volatile enough and it doesn't have enough range for it to be trended. And when it's not an average true range that's large, then many times you're going to get stuck in a back and forth motion. Now I'm going to show you two other examples on Forex. I'm going to show you the Australian dollar on a daily chart. Okay. The Australian dollar on a daily chart used to have an average true range somewhere about 100 pips. Okay, way back here in June, July, and August, it started going down a little bit, but still the average range was 100 pips. And when the average range is large, then you're going to have a lot of opportunities intraday in order to capture that 100 pips. Now, if the range drops down to below 60 pips, then the range on the day is going to be much less. So instead of having movement of where it averages over 100 pips back here in June and July, you have a movement of less than 60 here at the end of December. Now when it gets down to that low of a level, as an intraday trader, it is very hard to time into a trade in order to make money. And also on the larger time frame, so if you're trading a larger time frame, you may want to look at a average true range of a weekly, because the average true range of a weekly for swing traders is going to tell you on average how far that's going to move in a week. And with the timing of the daily or maybe a 4-hour chart, you have a good opportunity to capture those moves. Hopefully this video has helped you. If you have more questions or would like to comment on this video, please email me at ken@neilharmonics.com. Thank you.